Welcome to TheoTrade. This is Don Kaufman. It's February 8th, 2020, and you are watching the TheoTrade Weekend Update. Let's start with the fact that the S&Ps have ripped right back to effectively all-time highs. But really, some of the focus of this weekend's update is going to be, well, we're seeing sustained volatility near the all-time highs. The reason you have to throw a question mark is recognize right up front what you're looking at on the screen right here, right now, happens to be none other than the spiders. And inside of the spiders, of course, that's the S&P 500. We are seeing the marketplace effectively bounce right back to all-time highs. Everybody's at V-bottom. It's wonderful. They're high-fiving one another. And what they might be missing, though, is we're seeing, quite extensive volatility at those all-time highs. Of course, the S&Ps here on the Friday, they backed off 22 points again towards the end of the week. Nevertheless, the ranges that we're seeing on a day-to-day basis are nothing less than huge for a marketplace that is effectively at an all-time high. Let's start to kind of break it down a little bit. There's a tremendous amount, again, to cover on this weekend's update. Everything from China to Tesla to a ton of different trade opportunities. I got everything kind of detailed out. Let's start kind of a little bit methodically here. Let's go to the SPX to kind of begin with here and remove ourselves from a moment. What you think about the markets, what you think about an all-time high. Remove yourself from all of it. The reason I want to start once again in the SPX is, if you will, to describe right now, okay, what you're seeing in the marketplace, okay, in terms of, well, we'll break it down more quantitatively. First of all, we like to look on a week-to-week basis at the SPX expected move. Now, I'm going to take you over to an option chain here. So we cruise over to the option chain, and what we like to look at is the following Friday's expected move. That's right here. It's Valentine's Day. Okay, love with the expected move. So the expected move coming on Valentine's Day, this is effectively, okay, kind of a closing range, if you will, or anticipation of movement between now, okay, and next Friday. Now, that $50.42, okay, that is derived exclusively, okay, from the option chain, onto which there are literally billions of dollars being traded in. Just look at some of the volume, look at some of the open interest. In fact, you open up just a ton of strikes, okay? I mean, this is just a weekly option. And again, I can't reiterate this enough, okay? How much liquidity now is actually trading in the SPX? Just to give you an idea, yesterday being what, February 7th, 2020, the SPX alone did about 1.4 million contracts, which was actually not that heavy, but 1.4 million contracts of a $3,300 product. And then the spiders, of course, are trading the exact same thing as the SPX, and those are good for what? Couple million more. There you go, 3.1 million. And you start to see the effects, okay, of the S&P. And by the way, the entire market, for those of you who are a little new, the entire marketplace does about 25 million contracts right now per day. And you're getting the SPX doing, a million and a half, the spiders doing over 3 million. Before you know it, you're at 5 million contracts. I mean, a huge amount of liquidity is just passing through in the SPX when it comes to the option markets. And these option markets, they speak a tremendous amount, volumes, right? So you have this expected move of $50 that's based on billions of dollars of liquidity. And we take that expected move on a week-to-week basis, okay, and we put it specifically drawn on a chart. Now, to really kind of highlight and zoom in over here, I know it's a little bit, much to look at here in terms of all the lines, but once again, to kind of dictate to the this central line, that's where the week starts, okay? Then we have an upper edge of the expected move and a lower edge of the expected move. Now, okay, these are symmetric, okay? Last week, there was an $81.42 move expected. Effectively, we're saying 81.40, okay, 42. That could be higher or lower, and that's the expected move drawn on the screen. Now, this next week, we're looking, okay, for what? A $50.41 move, higher or lower. Okay, full stop right now, full stop. First and foremost, okay, we've been tracking expected move for what? over 3 years. In fact, I can pull up a 3-year daily. I've got data all the way back. In fact, we even have a script that can go back, infinite amounts of time on the SPX checking out expected moves. But these last 3 years, I've actually hand calculated all of the expected moves, physically drawn them on the chart myself, not using a script. And I do that for absolute precision, for absolute accuracy. Okay. And what we just passed through, and I want to display this to you because I think it's so critical to understand the marketplace right now. That's why I say sustained volatility near all-time highs, but a question mark because that ain't right, people. So the point that I'm trying to make with this is we passed through, about 20, 3 weeks. And I'm just highlighting a portion of this where we just stayed inside expected move, week in and week out. And that is indicative of a really efficient marketplace, a marketplace that just does what it's supposed to. It just grinds it out. Is it normal? Sure, it's normal. But the marketplace tends to go through periods of incredible efficiency, like we're seeing actually right here, to periods of where it really kind of comes apart at the seams. That's exactly the terminology I was using last weekend's video. And what we're getting right now, it indicates a breakdown of market efficiency. And what are we getting right now? Well, I want to first back up for just a second. You can see one of those periods, if you will, of inefficiency. All right. If we actually drop all the way back, and I'm just going to show you some of the dates in here. This is still in, it's in 2019. It's, May, where we actually breached the expected move, huge breach. Again and again, we were seeing these breaches, and that's in the midst of, again, fairly extreme and kind of tumultuous volatility. Back up a little bit more than that. The last time we saw also just wicked breaches of expected move was back in like October, November, December. And you can see subsequent, boom, like a couple of weeks in a row here of cracking through these expected moves leading into late 2018. And that was a really volatile time in the marketplace, and the marketplace was tanking at that time. Well, guess what? Here we are at all-time highs. And this is the one that's got, anybody that's into quantitative finance, they're scratching their heads on this one. You got to breach. That's 4 weeks in a row. 4 weeks in a row. And this last week was also a fairly substantial or major breach of expected move. And people they're like, whatever. You have to understand what it's saying. It's saying billions of dollars, are dead freaking wrong. They don't know what the hell they're doing in pricing options. And that may not sound like a lot to you, but when billions of dollars are wrong, you have to realize there's, it's chaos in the making. Because these markets, everybody's like, they're efficient. Believe me, I get into efficient market, hypothesis, get into all of it. Nothing's efficient right now. We're actually breaking down a little bit. And that's what I'm saying. Indicates a breakdown of market efficiency, breakdown of market structure. And you need to pay attention to this, because what is really, I think, eye-popping at this point. So you breach an expected move, and then they contract the volatility. You breach an expected move, then they expand the volatility. We breached to the upside. This past week, we flew. And by the way, this past week of trade, talk a little direction here. I mean, we started, on Monday, 32.25. We ended the week, 33.27. Let's put that in perspective. It's been a 100-point move to the upside. 100-point move to the upside. What were you expecting? 81? That's a breach. That's a huge breach. But after that breach, then they turn around, and the marketplace contracts the volatility. Then they say, we're only expecting now a $50 move this next week, which is still relatively volatile, and I can't stress this enough, all right? This means, number one, you don't want to be selling options premium right now. You do not want to sell options premium. We rally, we breach the expected move, they contract the volatility. You think it's worth selling a $50 expected move after seeing 4 weeks in a row smash through it? Not a chance. It's also telling you better expect a lot more chaos again coming in this next week. Forget about some of the news announcements. I could sit here all day and I could talk about the calendar. We could drop out to next week. We have the JOLTS number. We have the GDP. Forget it. Listen, everything is just going to be catalyst at this point to a marketplace that is, angry. And we haven't seen things settle down, which is exactly my next point. Where's the vol in all of this? What's volatility doing? Here's, again, one of the perplexing things. As I say, sustained volatility near all-time highs. First and foremost, we've all seen markets near all-time highs, and we've seen it recently. In fact, I'll cruise back over to the spiders here and just show you, okay? This entire run is markets at all-time highs. Let's not go any further. That whole run right there, all-time high, all-time high, all-time high. What was the VIX doing? I'm not much of a VIX connoisseur, but what was the VIX doing? Oh, I'll tell you what the VIX was doing. It was taking a dirt nap, okay? The VIX was down here at the, 12, 13 range. Okay, now, we're at all-time highs, right? You're with me, because the VIX is up in the 15 range, 15.5. Now, you haven't seen this too often, and sure, there's some spikes of VIX in that range, but you have an elevated volatility situation. Now, I'm displaying it in the VIX. There's a lot deeper methodology, to this madness over here, but you're at an all-time high with an elevated VIX. That makes us believe we're dangerous, but you can't just look at any one indication. But I'm also going to look at the volatility futures, because the volatility futures, these are interesting. They're really interesting because, and the volatility futures, not everybody in here follows vol futures, okay? This is a veritable geek fest. It's okay, but hey, listen, the volatility futures, all right, listen, if you look at the 39-day vol futures, versus like the 67-day vol futures, they're close. They're still trading within about 40 cents of one another. And the real signal, if you will, of market total pandemonium is like the March vol futures, that one that's at 1627, getting above, the 67-day. And we're within a stone's throw of that. And that's just dangerous territory. So the point that I'm trying to make over here, just by looking at expected move and looking at where vol is in all of this, we can discern immediately, volatility isn't really backing down. Like, it's a very dangerous situation. Now, I'm going to come back to that here in just a couple of moments, right? We'll include some bond talk in here. Come back to that in a second. Because I think at this point, all right, you stop and say, well, okay, all right, the volatility is elevated because we have a very unstable condition with China. Right? We have an unstable condition with the coronavirus. And, we could talk about the coronavirus to we're blue in the face and the economic, impact of the coronavirus to we're blue in the face, and nothing will come out of it. Nothing will come out of it because in the end, it's not necessarily, again, about the proliferation of a virus. Right now, all right, China, this is what's more important in the marketplace right now. They've just gone into full tilt liquidity madness. They've already put in, and this is now less than 4 weeks, 300 billion. That's 300 billion US. I need not, convert, but it's just $300 billion, in liquidity injections. Now, the way that they're actually doing the liquidity injections, does it matter? It's repo, it's this, it's that. The bottom line, they are flooding capital in. Realize that 300 billion, and you're like, that pales in comparison to what we're doing here with the Fed in the US. 300 billion, just to put perspective around this. The only thing that I could find, all right, that was relative in this was nominal GDP rankings by country. According to the International Monetary Fund, these are the highest ranking countries in the world, nominal GDP. The reason that I wanted to jump all of a sudden to GDP, when you start talking about 300 billion in less than 4 weeks, let's just put it at a month, Right now, the coronavirus, this is going to be a sustained mess for a period of time. This isn't going away tomorrow. It's not going away, a month from now. We're going to be hearing about coronavirus probably for the next 2 to 3 months minimum, assuming that we've actually already peaked out, which is nothing more than an assumption. Again, you could have every virologist, in the world talking to you about it, but it's not going to tell you the overall economic impact. What matters at this point is the liquidity injections. They are, monumental on the scale of GDP. I mean, if you look at Canada over here, Canada's GDP, it's only 1.7 trillion. Throw 300 billion against that. By later this month here in February, you realize that China could already be at $600 billion of liquidity injections. Again, the only way to put that to scale is to recognize, you're going to be challenging for in the top 10 spots, of GDP. That's how big their liquidity injections happen to be. And I realize everybody's going to be like, wow, they're short-term repos and they're this. It doesn't matter. For the most part, it's allowing them, to extend themselves and loans into the financial instruments, that are running this marketplace at this point. Now, you can take that as bullish. You can take that as bearish. Anyway, you want to take it. All right. But the only way to look at how wild these liquidity injections are is when you start to multiply it out. Hey, what if China goes and does 300 billion in liquidity injections a month for the next 6 months? You do some quick math. They overtook Canada as what? Okay. Well, China is the number 2 and number 10 in terms of GDP just because of liquidity injections. China right now is 16% of world GDP. That's the bottom line. Okay, they're totally, completely locked down at this point. It is going to have lasting impacts. The point of me showing you the $300 billion in liquidity injections, right? Listen, anybody can pick that up in the news. The impact of it is going to be felt possibly for years to come. This is huge. Right now, it is about central banks. The reason that I'm bringing it up, though, is specific to this, okay? Are they going to be able to sustain themselves? Or does the world actually literally turn, on their bank? And when I talk about like central bankers, just think of, 300 billion in liquidity injections. Think of it just like the Fed, forcing capital into our repo. Are we about to actually see, for one of the first times in recent history, a marketplace starting to turn specifically on itself? Liquidity injections may not be enough. Again, we'll come back to that in days to come. A little bit more depth, a little bit more explanation. Very, very dangerous times with these kind of liquidity injections. They're putting everything they got and firing everything they got, which leaves, very little, for a possible mishap. Or if the coronavirus were sustained, it can actually overcome their entire economy. China effectively right now is shut down. Now, we're actually going to look at some of the Chinese ETFs here in a moment. The next thing I want to bring up is just Tesla. Why? We're jumping from China to Tesla? Yeah, because again, it's a sign of the times. It's a sign of a manic marketplace where, year in and year out, we saw people go from cryptocurrency, then they went to all the marijuana stocks. Well, apparently Tesla's become like the new marijuana stock, the new cryptocurrency over here. It's a sign of manic times. There is capital, being put to work over here without rhyme nor reason. I think that looking at Tesla, though, is a distinct fact that there's no fundamentals, and it really expresses just that. There's no fundamentals behind a marketplace, and I think that we can make a lot of arguments for that in a wide array of individual stocks. Nevertheless, Tesla being, the preeminent, position here to say that, this is, again, manic marketplace. If you look at the auto expected moves, this is actually a script designed around expected moves. And we talk about breach of expected moves. Look how many breaches of expected moves we've had. They still haven't gotten it right. That's 1, 2, 3, 4, 5. 5 weeks in a row. In fact, the move up here in Tesla was actually over a 5 deviation move at one point, over a 5 standard deviation move. That's a standard deviation move as depicted by the options. If the option said, for instance, we're going to move $30 and we moved $200. I think you guys get what I'm saying over here. In effect, we're saying also inside of Tesla, it doesn't matter how high the implied volatility happens to be. In fact, if you look at the option statistics, the IV is actually contracted in there. Doesn't matter how high the IV is. Still not worth selling option premium if you know you're about to get run over. And evidently, you are going to get run over in here. Again, sign of the manic times. All right, next thing. Let's look specifically at the marketplace. Really, just yesterday, which was Friday, we saw some sell-side activity. And this is one that we're still, I talked to a lot of other traders in the industry. I think a lot of us are still scratching our heads. A rally, the rally back on higher volatility. But the one thing that just really grabs me here is the jobs number. The jobs number. The jobs number was huge. And this came out, and again, I just want to highlight it for a second. This is the S&P futures, and I'm actually taking it all the way down, to a 1 day, 1 minute. Right there. So it came out an hour before the cash open. The jobs number was absolutely huge, like 225,000 jobs. They actually pushed forward estimates from previous months, meaning that, again, some of the previous months were better than they had originally anticipated. And the jobs number was huge right until they sold into it. Again, it's a little bit of a head scratcher. Good news, bad for the marketplace. And the exact same time, this is where we're going to start to bring bonds into this. The exact same time, the bonds, they rallied. And that's where, again, this is very counterintuitive. So good jobs number, better economy. Okay, better economy, well, we don't necessarily need the Fed to be cutting rates. No, but the bonds rallied, which effectively does take down the interest rates. And I want to reiterate this because all three of these kind of tie together over here. When I say all three of these, the jobs number was huge right until they sold into it. Okay, but they had to rally back. We rallied on higher volatility, which was strange. But then the bond yields have only recovered mildly. The reflation trade is completely and utterly dead. And now I'm going to put a little bit of explanation behind that. Let's actually cruise over to the TNX. The TNX happens to be the 10-year Treasury Index. I mean, this is what sets your mortgages. Okay, here's one of the points that I want to make. We see, an absolute rip-your-face-off rally early this week. As I just showed you a moment ago, the S&Ps were up 100 points on the week. Now, as the S&Ps, were ripping to the upside, this little interest rate here also takes off to the upside. But really, we saw some sell-side activity on Friday. After the jobs number, they sold into a good jobs number, which is, a little curious out there. Maybe it was some fears of China. We sell into it, and they actually take the interest rates down, and they gave back basically half the gains of the interest rates. We're closing the week, about 1.578%. It's this is a little bit scary to me because once again, the bonds, and I think that the way to most effectively display this, the bonds, they're just not giving up an inch. They refuse to give up an inch. And when you start to look at the bonds, you have to kind of question, looking at the bond market, is the bond market being used as a defensive instrument? Okay. Basically, I'm asking, is capital coming into the bonds just because it's looking for a place to hide because the S&Ps look downright scary? Now, I can't look at the bonds autonomously and say that. I can't look at volatility autonomously and say that, But I can do this. I can look at all defensive sectors. What's defensive sector? That's a place where, traders put money when they're a little fearful. Defensive sectors and stocks, they're just not backing off as one would expect in the midst of the rally. So you see this rally back, and again, I'll drop the spiders in here. We see this just wicked rally right back to all-time highs. And you see this flood of capital coming in. And by the way, you also have to remember that this wicked rally to all-time highs, it isn't being done on the back of the whole marketplace. It's being done on the back, of big technology. Big technology over here. So I want to show you some of those defensive stocks to kind of begin with. So if you take a look at XLU, so the bonds are not really giving up an inch, right? And that makes me fearful because I think capital is flowing into the bonds because people are, they're scared. Then you look at the XLU. Now, if the marketplace, was rallying, everything's going to be hunky-dory and we're all going together, hand in hand, why are they dumping money into the XLU? Because it pays basically a 3% dividend. Interest rates, the reflation trade is totally dead. Here you go. So they dump money into the XLU. It's not just the XLU. They dump money consistently into XLP. It's consumer staples. If you haven't looked at consumer staples, you're missing this. You're missing the boat here. Consumer staples hasn't really played even much of a role in terms of the volatility. This thing's effectively sitting at an all-time high. And the irony is, it finished higher, minimally, but it finished higher. It's one of the few sectors, that was unscathed in Friday's sell-side activity. So now we have the XLP rallying. We have the XLU. And again, the XLU, which is utilities, it's sold off 0.3%. It's negligible. Then I looked, obviously, TLT. TLT is just another version of the bonds. I'll just mention it momentarily here. TLT ripped right back almost to all-time highs. What else we got after that? Oh, I like to show this. This is one that's off everybody's radar screen, right? This is actually the real estate. This is a lot of REITs and so forth. Effectively sitting right butting up against all-time highs. Again, little effect of the volatility of the last couple of weeks. So again, defensive sector, then defensive stocks. Whenever I think of defensive stocks, I think of communications. I think of like AT&T and so forth. AT&T sitting again, negligibly off their all-time high. The reason I'm bringing up AT&T, earnings, not great. The stock sold off big on earnings. It didn't matter, right? They bought it, and they bought it, full tilt bought it. They bought it right back up to where it was before the earnings announcement. Why? Because it pays a heavy dividend. Then we have to look at Verizon. Verizon's the exact same thing. Verizon, the earnings came out. They sold into it. Stock sold off heavily before. It's rallying right back up. But again, Verizon also had a couple of warnings out there, but 4.1% dividend. It doesn't matter. As long as you're paying a good dividend out there, it does look Like if you put all the pictures of the puzzle together, we look at bonds. And they continue to be extraordinarily high with lower interest rates. We look at defensive sectors. Well, the XLU, the XLP, okay, the real estate sector. We look at individual stocks in there. All of them are saying, portraying a lot of risk. Okay, what else you got? And it just goes on and on and on and on. Volatility is a little bit higher. So again, jobs number. Let's move on. Last but definitely not least, let's get to what I call kind of stock chop over here, bounce and fade trades. Now, I'm just giving you a couple of symbols right now, okay, in brief, momentary, couple of symbols that we're going to be looking for bounce and fade. Now, stay away from parabolic tech. So in bounce and fade trades, it's me going out looking for trades using in-out spreads. Now, in-out spreads, I'm looking for markets that'll head up, bounce down, head up, bounce down, any kind of volatility. It's not so much about directional bias. It's more about volatility, right? As long as these stocks are bouncing back and forth, then we're going to be fine. Stay away from parabolic tech. I just told you that. Look, Microsoft, this isn't bounce and fade. This is called get run over. Okay, that's not going to be any fun. Not going to be any fun for anybody. Parabolic tech, not a good place to be. Parabolic tech, again, not a good place to be because there's not back and forth trade. It's a one direction. All right. You want to see a good bounce and fade kind of candidate? Take a look at something like XLE, the energy sector right now. The energy sector. Okay. Look, sold off big, bounces, fades, right? We've already had some bullish trades inside of the XLE, worked out beautifully. If you don't like that, you can actually look at something like UNG. So here's one. I'm still waiting for the bounce, baby. Okay. All right. Next one. Anything in the financials. The financials really bounce and fade is working in here. Look at the volatility inside of the XLF. You were short, you were long, you were so short that you were long. Bounce and fade. Okay, I'm all over. Instead of actually trading the XLF, you're more comfortable. You can actually look at something like JP Morgan. Bounce and fade trades are working in here. Okay, FXI, and I'm just going to skip right down the list over here. FXI, all right, this is actually China. It's the ETF. Okay, thing gets absolutely clobbered. Liquidity injections come in, save the world over here. If FXI is a little bit steep for you, take a look at something like EEM. EEM is also, it's heavily weighted similarly to FXI. Okay, I'm also watching things like Starbucks, also having a lot of impacts, okay, and volatility lately. Bounce and fade trades are totally in play right now. And again, if you're looking at this and you're like, you don't see it, well, you're going to, because I'm going to be allocating a lot of capital as long as this volatility and the back and forth is sustained. People, this is the kind of trade that we live for. This is the kind of trade. And I'll just skip right down to the last one. Last but not least, let's actually look at Alibaba. Alibaba, in terms of bounce and fade, recognize how far Alibaba's come. Now, I know it's got earnings right around the corner. We're probably going to wait till after the earnings to jump on a trade in here. But talk about a fade, a bounce, another fade over here. Any one of those candidates, okay, is absolutely perfect for sustained volatility. Okay, really near all-time highs. They're perfect candidates too for in-out spreads. Listen, huge amount to think about in this weekend's update. Be aware, all-time highs, volatility sustained. Okay, fairly manic times. The expected moves are breaking down. Look for more breaches of expected move and more chaos and trade throughout the course of this week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.